Hello and welcome back to our channel. In today's detailed analysis, we are focusing on a prominent name in the Asian real estate market, Mapletree Can Asia Commercial Trust, also known as MPACT. We'll be breaking down its unique portfolio structure, examining its financial health, and exploring the dual narrative of domestic strength versus overseas challenges that currently defines it. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. To begin, what is Mapletree Pan Asia Commercial Trust? MPACT is a diversified commercial real estate investment trust. Its portfolio is a strategic blend of office, business park, and retail properties located in some of Asia's most important gateway cities. The trust has a significant presence in 5 key markets: Singapore, China, Hong Kong, Japan, and South Korea. The cornerstone of MPACT's entire structure is without a doubt its Singapore portfolio. These domestic assets are the engine room of the trust, contributing approximately 54% of its total net property income. This heavy weighting towards Singapore provides a crucial layer of stability and income visibility. Think of it as a strong anchor in a potentially volatile sea. This domestic income has been essential in buffering the trust's overall financial performance, especially when its overseas contributions have faced headwinds. 2 of its crown jewel assets in Singapore are VivoCity, one of the nation's largest and most popular retail malls, and Mapletree Business Park, a premium business park. These properties are not just large, they are market leaders in their respective segments. The high concentration of income from Singapore also provides a natural hedge against foreign currency fluctuations, ensuring that a significant portion of its earnings is in the stable Singapore dollar. While the Singapore story is one of resilience, the trust's offshore portfolio, particularly in North Asia, has faced a more challenging environment. This is a key part of understanding the complete picture of MPACT. In China, for example, the trust has experienced negative rental reversions. This means that when leases expired, they were renewed at lower rates. For the full financial year of 2024-2025, this negative reversion was a significant minus 11.4%. However, there's a crucial trend to observe here. The rate of decline is slowing. In the final quarter of that year, the negative reversion had already narrowed to 9.4%. This deceleration is an important technical indicator suggesting that rental rates may be approaching a floor or a point of stabilization. Over in Hong Kong, the trust's major asset, the Festival Walk Mall, has also been navigating operational weakness. However, analysis suggests a defined timeline for recovery, with projections indicating that rents should stabilize within 1 to 2 years. This is supported by broader, albeit tentative signs of recovery in Hong Kong's overall retail sector. To address these overseas challenges proactively, MPACT's management has been actively optimizing its portfolio. For instance, the trust has proposed the divestment of 2 non-core office buildings in Japan. The stated goal of this move is to reduce single-tenant risk and improve management efficiency. The proceeds from this sale are specifically earmarked for further debt repayment, underscoring a commitment to de-risking the balance sheet. This brings us to one of the most compelling aspects of MPACT's current strategy: its disciplined capital management. The trust has demonstrated a clear focus on strengthening its financial position. A prime example was the divestment of the Mapletree Anson property. Instead of reinvesting the proceeds into new acquisitions, management made the strategic decision to use the cash to reduce its overall debt. This directly led to a significant 16.4% year-on-year improvement in finance expenses in the first quarter of the 2025-26 fiscal year. This reduction in costs has been vital in cushioning the impact from the weaker overseas income. As a result of these efforts, the trust's balance sheet appears robust. As of June 2025, its aggregate leverage ratio stood at a conservative 37.9%, a notable reduction from 40.5% just a year prior. This is well below the regulatory limit of 50%, providing substantial financial headroom. Furthermore, its ability to service its debt is solid, with an interest coverage ratio of 2.9 times. Beyond just reducing debt, MPACT has also been prudent in managing interest rate risk. An impressive 77.7% of its debt is on a fixed rate basis. This strategy protected the trust during the recent global cycle of interest rate hikes. Now it presents a potential structural advantage. As older, more expensive hedges expire, the trust may be able to refinance at lower market rates, creating a predictable path to lower interest costs, and consequently, a potential uplift in its distribution per unit, or DPU. We are already seeing evidence of this, with the trust's all-in cost of debt falling from 3.51% in March 2025 to 3.32% by June 2025. Circling back to the Singapore anchor, the operational outperformance here continues to be a powerful driver. VivoCity reported a strong net property income growth of 6.0% in the first quarter of fiscal year 2025-26. What makes this particularly impressive is that this growth was achieved even while the mall was undergoing significant enhancement works, demonstrating its dominant market position and pricing power. Looking ahead, the completion of the Circle Line MRT loop in 2026 is expected to further boost the mall's accessibility and strategic value. Similarly, Mapletree Business Park is benefiting from a structural trend in the office market known as the flight to quality. In an environment with rising supply of office space, companies are increasingly prioritizing premium, well-managed, and amenity-rich buildings. MBC fits this description perfectly, which helps it maintain high occupancy and tenant confidence, insulating it from the rental weakness seen in older, lower-grade office buildings. From a valuation perspective, MPACT has been trading at approximately 0.8 times its book value. This is noteworthy because many of its large-cap Singapore REIT peers have re-rated back to or above their book values. Historically, the trust's share price has faced challenges, but recent market activity, including a 13% gain in the 3 months leading up to October 2025, suggests that market sentiment may be shifting, perhaps in anticipation of interest rate normalization and earnings stabilization. In conclusion, Mapletree Pan-Asia Commercial Trust presents a multifaceted profile. It is anchored by a highly resilient and growing Singapore portfolio that provides a stable income base. This domestic strength is balanced against tangible headwinds in its North Asian markets. However, there are clear technical indicators that these overseas challenges may be bottoming out. Crucially, the trust's management has implemented a disciplined financial strategy focused on de-risking the balance sheet through debt reduction and prudent interest rate hedging. This has already resulted in lower finance costs and creates a structural pathway for potential DPU growth, independent of a full operational recovery in its offshore markets. We hope this in-depth analysis has provided you with a clear and comprehensive understanding of Mapletree Pan-Asia Commercial Trust. The goal, as always, is to provide educational content to help you become a more informed observer of the financial markets. Thank you for watching.